Hello, everyone. My name is Ryan Antkowiak. I am a financial advisor and certified financial planner with a firm here in town called Baird. I'm also the president-elect of the Financial Planning Association of Minnesota, and I'm so excited that you are here with me today to learn a little bit about investing. I hope that you're getting a lot out of your Financial Planning Day session today, as well as any other sessions you may join, and of course, any in-person or virtual meetings that you have with planners here in town. So thanks again for being here, and I'm going to get right to it. So today we're talking about investing basics. How do you become a smart investor? Some of the things that we're going to cover today is exploring investing and concepts. What are some key terms? Explain how investing fits into an overall financial plan, introduce some general investment strategies, and discuss ways to put these strategies into action. What we're not going to do is try to time the market or help you be a top stock picker. We're not going to provide any insider information, and we're not going to recommend anything specific because investing is really unique to you, your time horizon, your risk tolerance, and we will dive right in. So what does it mean to be a smart investor? There's really 5 components that make a smart investor. You have to have a good, strong foundation of saving. Once you have a comfortable savings threshold, then you can consider, how do I invest? How do I put money to work? In order to do that, though, you need to really have a sound grasp of how much risk are you comfortable? What sort of a return are you striving for? And we'll talk about some strategies that can help you with that, one of which is considered or called asset allocation, as well as diversification. I think we've all heard you don't want to put all your eggs in one basket. So we'll get into exactly what does it mean to diversify your investments. We talked a little bit about savings there right out of the gate. Saving's really important, and I would argue that saving is a precursor to investing. Saving, just as defined, is putting money into a savings account or money market account for the goal of earning some interest. The money can be made available and used immediately. It's not tied up for any period of time, and it's really there as a safety measure or security blanket in the event that you need it. Investing, on the other hand, is when you put money aside for the opportunity for it to grow or to provide some income or both. When you invest, there will typically be a fluctuating rate of return, and you must sell a portion of your investment in order to access that cash. There's also the possibility that when you invest that you don't make money. It's possible that you'll invest in something that goes down, and we'll talk a little bit about some of those characteristics as well. So what are some reasons to save versus reasons to invest? Well, first and foremost, as I mentioned before, I think it's really important that you have a savings account or some savings established before you really consider investing. So when you think about, well, what would I need a savings for? It would be for an emergency. Generally speaking, an emergency fund is a prudent thing to have, which could be anywhere from 3 to 6 months worth of your fixed expenses. So consider having an emergency fund. You might also save for a vacation or some short-term goals. Perhaps you're going to put an addition on your house, for example. You need to set some money aside here in the short term to fund that project. An investment, on the other hand, tends to be longer term in nature. You save more than likely for retirement through a retirement account, such as a 401k, an IRA, perhaps a Roth IRA. You might invest for college. You might invest for other long-term goals. You might even invest right now for monies that you could access, but they're really designed to supplement retirement or to be used at a later date. And we'll get into that some more. So first and foremost, I'd like to start off by just sharing a quote here. Investing 101, the top investment rules: a goal without a plan is just a wish. And I think that's really important. It's important that when you set up an investment account, you know what you're trying to accomplish with that account. Ideally, you know what those funds will be used for. You'll have a good grasp of how much risk you're willing to take to achieve those goals. Here's just some 8 steps that we typically would recommend. First and foremost, have that emergency fund. You don't want to put all of your money in the market or in any vehicle that runs the risk of going down if you might need it tomorrow. If you need to put a new roof on, for example, you'd rather not dip into your 401k to put that roof on. It's something that needs to be safe and secure. Also, it's important to mention that you don't need to be safe to succeed. The stock market over the history of time has always grown. Now, of course, there's been some temporary setbacks along the way, but every so often we achieve new highs. In fact, this year we've even achieved a new high despite what's been a very, very challenging environment with the pandemic, civil unrest, and everything else. It's also really important to diversify your investments. We'll talk a little bit more specific about what that means, but again, not putting all of your eggs in one basket. When working with my clients, what I've always noticed is that anytime clients automate their investments, they tend to save more money because otherwise you're only investing when you think about it. And if you make it a habit, you will save more over time. It's also important to understand how taxes play a role. So we'll talk a little bit about that. And anytime you make an investment in something, you want to understand how do the taxes work. We'd caution you to beware of hot stock tips. Typically, if someone is sharing something with you or you've read it in the paper, whatever that stock is or whatever that investment is, it's had its run already. You're probably more likely to see that investment go down than go up at that point. So you don't want to be looking for hot stock tips because more often than not, you will not get that right. Again, I mentioned a goal without a plan is just a wish. So have a plan, know what you're striving for. And if you need help, seek professional advice from someone like me, from perhaps a close family member or friend, anyone that you can really just, talk big picture goals with. It doesn't have to necessarily be a financial advisor to get that advice. Sometimes talking things out is the best recipe for success. So keeping it high level here, first and foremost, what is a stock? A stock is simply buying a little tiny piece of a company. I like to use some local examples. We all know that 3M, Target are based here in the Twin Cities. So if you buy a stock and you buy Target stock, for example, you are an owner of that company. Now, albeit a pretty small owner, but Target stock is split up into thousands and thousands of shares, and you become an owner of that stock. Well, people ask, well, why do stocks go up? Why do stocks go down? And there's a lot of things that play a role into that, but essentially it all comes down to supply and demand. If we're talking about Target again, if they have a really successful quarter, they sell more than they were expected to sell, the stock might rise. On the other hand, if they don't do as well as expected, the stock may fall. When you own a stock, the company has the ability to either reinvest that growth back in their company, which is called retained earnings, or they can pay a dividend to you as the shareholder. When you think about how you want to invest, it's important to know how is that money going to be distributed? Will it come to you or will it be put back into the business? Now we'll talk a little bit about bonds. Bonds, I think, are often considered safe, conservative, and when compared to stocks, they certainly are. But really what a bond is just a form of borrowing. When a government issues a bond, the money that they receive in return for that loan is repaid to them over time with interest. So you give your money to a company or to a government, and for that money, they will pay you a stated amount of interest for that. It's also true for corporations. So Target, again, for example, does issue bonds, and you can loan money to Target so that they can expand or roll out new lines, for example. Also, an important concept of bonds is the yield. So when you invest in a bond, you know what type of interest you will receive. But it's important to know that when interest rates go down, the price of bonds go up. And just the opposite is true as well. When interest rates go up, the price of bonds go down. So there is risk associated with bonds as well, just a different type of risk when compared to stocks. Talk a little bit about mutual funds and ETFs. These are both very common investment vehicles. Both mutual funds and ETFs are products that you can use to invest in a diversified portfolio right from the beginning. You're investing with a group of other investors. That money is either professionally managed or mimics an index. But again, the key here is that when you invest in a mutual fund or an ETF, you are one of many that invest in that exact same portfolio, and it gives you easy access for diversification. There are some differences between mutual funds and ETFs. Probably the biggest one is that mutual funds are not listed on the stock exchange, and ETFs are listed on the stock exchange. Again, I think the key thing here is you would use these vehicles to give you instant diversification versus picking a large basket of stocks all by yourself. Financial planning, I kicked off the call by sharing that I'm a certified financial planner. Financial planning is a big part of investing. Understanding what are we investing for. So some of the other considerations that go along with that, in addition to investing, is having a good understanding of your employee benefits. Are you maximizing what your employer gives you? How do you approach insurance? Should you have insurance? Do you have too much insurance? Those types of concepts. Tax planning. The way I always talk with my clients is, if I save you $1 in taxes, that's just as valuable as earning $1 in return. So being mindful of how taxes work is really important too. Retirement planning. When should I retire? How much should I, or how long until I retire? How do I make decisions with Social Security and Medicare? That's all part of financial planning. And also estate planning. How do we position our assets to transfer to the people that we care about or the charities we care about on our terms? So how do you set yourself up for success there? Pivoting back to investing. Before you invest, again, it's important that you have that savings, you have an emergency fund. And I also think it's important to have a strong handle on your cash flow. You want to make sure you have more coming in than you do going out if you're going to start investing. So before you invest, you want to make sure you have a good handle on that cash flow. You do have some money set aside in the case of an emergency. You ideally pay off any credit card debt or student loan debt if it's a nominal amount, as well as evaluate your insurance coverage and have a basic estate plan, whether that's a will or a trust, other vehicles. But again, I think the key is you just need to have a good handle of your cash flow before you start to put money to work in the stock market. Sorry about that. Not sure exactly what happened there, but we're back at it. Thanks for hanging with me. So let's talk a little bit about how to start investing. Probably the easiest way to start investing is to do it through your work. A lot of times your employer will offer employer-sponsored retirement plans that in the most common form is called a 401k, but depending on your work, it could be called a 403b, a SEP IRA, a simple IRA. There's a number of different vehicles. If you don't have anything offered through your employer, you could set up your own individual retirement account, IRA, or a Roth IRA. And we'll get into a little bit what those differences are. You can contribute to an educational or health savings account, or you can invest in taxable accounts, which just means that you're setting some money aside outside of a retirement account to invest either for the short term or long term. Again, I talked about how important it is to have a plan. You want to know, when do you plan to use these monies, because that will influence how much risk you should be willing to take or accept for that period of time. For example, if I knew that I was going to buy a home in 6 months, I wouldn't want to take my entire net worth and put it in the stock market, because if we were to catch a bad couple months here, the amount of money I set aside for that home could dramatically be down. It's just not worth taking on that type of risk. On the other hand, I'm 38 years old. I'm not going to retire for a very, very long time. So I can stomach and handle volatility in the stock market as I get closer and closer to my retirement. I've got time to make up for any bad years. And as I mentioned earlier, the stock market consistently hits new highs. It does just have some temporary setbacks along the way. Once you have your plan in place, you want to make sure that you're selecting prudent investments and you're really having a good grasp of how much risk you're taking. And of course, you want to pay attention to that portfolio. Talking more about goals, again, it's important to know the time frame. Again, a shorter term investment should always be more conservative than when compared to a long-term investment. Talk a little bit about risk and reward, or risk and return. Risk is really the possibility that you could lose money. The more risk you take, the greater the potential for large returns. And return is really just what percentage you get back based on the amount that you invest. Again, the riskier the investment, the higher potential for returns. So thinking about risk, thinking about your risk tolerance, how much risk should you take? These are some questions you should ask yourself. And there's a lot of tools, especially if you're investing with your employer. They likely have some questionnaires that will help guide you in terms of how much stocks and bonds, or one or the other, you should have in your portfolio. So here's some questions to consider. I also think it's really important to be realistic. When you make any investment, you always run the risk that you could lose money. So you need to recognize that markets go up and down. a lot of times just comes down to when you invested. If you stick with an investment long enough, you should make money on that investment. But again, that time horizon is extremely important. And remember that if you use only insured accounts like a CD or a bank account, your upside is very limited. The safety is there, but the upside is limited. So it's important, in my opinion, to always have some stocks in your portfolio, regardless of your age. And again, I think it's important to really evaluate what should your rate of return expectations be based on the investments that you choose. So let's talk a little bit about a few different types of investments. We've got large company stocks, Target and 3M, examples I gave before, among many, many others. Small company stocks and US government bonds. Now, large company stocks tend to be the most commonly purchased and owned stocks because people like to invest in things that they've heard of. Not only that, large companies are unlikely to go out of business if we find ourselves in an economic downturn. The long-term rate of return for large company stocks is almost 10%. That goes all the way back to 1927. So that doesn't mean it'll go up exactly 9.74% each and every year. But if you hold it long enough, that's the historical rate of return. And the longer you hold something, the more likely it would be to reach that rate of return. Now, small company stocks, as you can see, have done better actually than large company stocks, but they come with a lot more volatility because if we have an economic downturn, a smaller company may not have the ability to maneuver a difficult environment and could shut their doors. Certainly possible with large companies as well, but less likely. US government bonds are a very common type of bond that's purchased. They're viewed as very conservative vehicles. The long-term rate of return on bonds are about 6%. However, I got to be honest, the last 10, 15, 20 years, the rate of return on bonds hasn't necessarily been quite that high with interest rates being as low as they are. It's difficult to get an attractive interest rate in this environment. Talk a little bit about asset allocation. So the concept behind asset allocation is you want to slice and dice your portfolio so that you are not putting too much risk in any one particular category. So for example, stocks are more aggressive than bonds, bonds are more aggressive than cash. So you want to blend that mix together so that you know exactly how much risk you're taking and what your probability of achieving the rate of return is. So dividing that principle among the different asset classes. Here's just a sample asset allocation. This is not being recommended for anyone in particular, but you could build a portfolio that was 65% stocks, 25% bonds, and 10% cash. Putting an asset allocation to work. Now, again, I think how people invest is very personal. Just because you're young or you're old doesn't mean that you should do something because that's what everyone else does. But generally speaking, if you're young and you're investing for, say, retirement, you have a much longer time horizon than someone who is older and investing for retirement. So you could make the case that you can afford to take more risk because you have more time to overcome setbacks. So generally speaking, younger investors tend to have more stocks in their portfolio than they do bonds. And as you age, you tend to pare back the amount of stock exposure that you have in favor of bonds. But again, I want to highlight every investor is unique. This crazy looking chart reminds me of the periodic table back in your science days. But really what this aims to show you is, if you follow left or right, is what was the top performing investment classes, or asset classes rather, from 2004 to 2018. Not going to walk you through every single column, but looking at 2004, the very best asset class to own in that year was REITs, real estate investment unit trusts, or investment trusts, excuse me. It was up 31.6% in 2004, followed by emerging market equity, domestic equity, small cap stocks, high yield bonds, large cap stocks, so on and so forth. The white square is if you just had an asset allocation portfolio where you had a little bit of weighting in all of these different portfolios. And as you could see, if you go year to year, not the same asset class was the best. In fact, a lot of times, the best asset class may have been the worst asset class the very next year. So it's important that you don't try to chase what's done very well. If you spread that risk out, you tend to stay in the fairway or hit singles and doubles if you're a baseball person. You want to stay in the game, but you don't want the volatility that comes with just picking one investment or one asset class. So now we're going to talk a little bit about diversification. Now it's similar to asset allocation, but it's when you slice and dice the stocks and the bonds just a bit further. It's an investment strategy that you can help you control the risk without reducing the potential for a strong return. So again, you want to spread that risk out. If we're talking stocks, you want to have some large company stocks. You want to have some small company stocks, maybe some international stocks as well. You want to spread that risk out among different types of investments. And again, there's plenty of tools out there that can help you get a sense for what would be a good starting asset allocation. Same thing with bonds. You want to diversify there too. Short-term bonds tend to pay less interest because they don't last as long, whereas longer-term bonds allow you to clip a better rate of return or a better interest rate than the short-term bonds, but you've got to hold them a lot longer. Consider a combination of all those things, as well as own some individual stocks, own some mutual funds, own some ETFs, own some individual bonds. Again, the idea here is you don't want to put all your eggs in one basket. I will tell you, for people that start out, usually the easiest way to invest is to pursue a mutual fund or an ETF, because they, by design, are diversified, which takes a lot of the onus off of you of having to try and pick and choose what exactly should you own. Create an investment plan. We talked some about this. Again, I think it's important that you do a little bit of homework, know what you're getting into. And if you have questions, ask for help. There's nothing wrong with that. There's plenty of people out there, from advisors to other people in your life, that I'm sure would be happy to help you work through some of those questions. Here we go again. Why won't this slide change? There we go. All right. So what are some common mistakes that we see? Sometimes people get really fixated on a particular stock. Apple, for example. Apple's a great stock. It's had an amazing run, and it more than likely will continue to have an amazing run. But if you put all of your capital in an Apple, how you do isn't really based on the stock market. It's based on apples. You want to try to spread that out. Also, I would encourage people to don't put money in investments you don't understand. It doesn't have to be overly sophisticated. Investing in stocks or investing in bonds can be pretty straightforward. You don't have to be an expert in what you own, but you want to make sure you understand how does the product work if you're investing in something other than an individual stock or an individual bond. Don't overload on company stocks, and don't chase hot performance. Again, don't put all your eggs in one basket. Try to spread that risk out so that when some investments are yinging, the others are yanging, and it balances itself out over long periods of time. All right, so let's talk a little bit about investment approach. Starting investing early. The sooner you start your investment, the more time you will have to allow that compound interest to compound on itself. You will allow your investment to grow. As I mentioned earlier, automating your investments is so key. If you only invest when you think about it, you're just not going to invest as often. So when you can do things like make a direct deposit from your paycheck into a 401k, you kind of set it and forget it. And that allows for better long-term growth because you're adding to it each and every month or each and every paycheck. And I can't stress this last one enough. You want to stay in the market. Once you've developed an investment strategy that is prudent, you don't want to try to choose your spots. The second you completely get out of the market, you're going to miss a run. Or if you try to time the top, it's going to go higher. More often than not, I'd even go as far as to say almost always, you want to stay in the market. Again, if you have an investment plan and you feel good about how you're positioned at onset. Talk a little bit about time value of money. Again, this gets back to investing early. If you were to put $10,000 in an investment and it earned 8% per year, if you held that $10,000 investment for 10 years, it would more than double 10 years later. It'd be worth $21,000. If you let it run for 20 years, it'd be worth $46,000. And if you let that $10,000 investment run for 30 years, it will be worth more than $100,000 again, based on these assumptions. So the concept here is the longer you let your money work for you, the better off you're going to be. So what are some things to think about when you're choosing your investments? I think expenses are important. You want to make sure that you're investing in vehicles that are not overly expensive. You also want to be aware of taxes. It's important that you understand how taxes work depending on the type of asset you invest in. For example, an IRA versus a Roth IRA will dictate the taxes. You want to make sure that your investment strategy is on target. When you develop a portfolio, you want to make sure that you know what the expectations are so that if you have a bad year, that doesn't mean the investments are bad necessarily, but you want to make sure it's doing as well or close to as well as the markets as a whole. It's also important to rebalance. And all that means is that once you've selected an asset allocation and keep it really high level, again, 65% stocks, 25% bonds, 10% cash, every so often you want to just rebalance that back to 65, 35, 10 if that's your allocation. Because if you don't, the investments will move on your own and you may have more stocks or more bonds than you intended to, which can stunt growth over the long haul. Also important to recognize that change requires change and allocations can shift. That's essentially what I was just describing. If you just let your investments go without a rebalance, you may actually be taking on more risk than you realized. It's also important to recognize that your investment plans can evolve. It's important to set one at onset, but things change. You lose a job, you get married, you inherit some money. All of these things will factor in why you might approach something differently. Looking forward, just know that along the way, you're going to have some years that are better than others, and you're going to make mistakes here and there. But if you've got time on your side, I assure you that the market will prevail, always has, always will, may have some temporary setbacks along the way. But the sooner you put your money to work for you, the better off you're going to be in the long term. To summarize, again, there's people out here to help you, like me, other planners that are available today for the one-on-ones, or this week, I should say. And again, don't be afraid to tap on your friends or your family. We're all in this together. Keep in mind that your situation is unique. Now you can learn from others, but how you feel about your money is really important. So it's important that you think about that. And keep in mind that you're responsible for your investment results. You want to make sure that you understand what you own and you can recognize how much risk you're taking or not taking. I also want to highlight that we're here to help. Of course, we've got this week-long financial planning days, but here's some great resources that you can lean on as well. The Financial Planning Association of Minnesota throughout the year has pro bono outreach that you can tap into at any time, and we are happy to help you in any way that we can. I appreciate you attending this class on investing. That's it from here. Thank you so much, and hope to see you in the future at a future financial planning days. Take care. Bye-bye.